Good morning, everybody. This is Gil Morales coming at you with Dr. Kacher, Dr. K, Chris Kacher, here today on our session 3 of our Disciple Boot Camp, commemorating our new book, In the Trading Cockpit with the O'Neill Disciples. And we did kind of hold off for just a little bit here as we let more people log on, so that's why we're just a little bit late. But we got a packed house today, and we're going to talk about what we refer to as the 7-week rule. And before I get going here, we just have to take care of the legal aspects here and just let you know that the information or any of the stocks that we're talking about in this presentation are not intended as recommendations or offers to sell or solicitation of an offer to buy any securities. So the information we're using, we believe, is reliable, but we're not going to guarantee that it's reliable. And all of this is subject to change without notice. As well, any stocks that we talk about, we may currently be long or short the stocks, not that it really matters. And also, we want to remind everybody that investing in stocks carries a high degree of risk and can result in significant losses. Dr. K and I both know this because we've had that happen from time to time. But investors should always operate with a concrete risk management plan in place, including the use of strict stop-loss points in order to control to the greatest degree possible the inherent risk of investing in stocks. In other words, use all this material in this presentation at your own discretion and at your own risk. But what we're going to talk about today is designed to help control risk and also designed to help you know when to take profits in stocks and lock in profits and understand the character of the stock in terms of the stop-out point. And what we do essentially is we use either the 10-day or the 50-day simple moving averages in conjunction with pocket pivots, Bible gap-ups, and other buy points, all of which is governed by what we call the 7-week rule. Now, what happens in most cases is that stocks will tend to develop a personality or character whereby they follow either the 10-day moving average, so they'll have a tendency to obey or respect the 10-day moving average, and if they do it at least 7 weeks within an uptrend, you're going to use the 10-day moving average as your stop. So the basic idea here is if the stock follows a 10-day and has been doing that for 7 weeks, then you're going to use a 10-day moving average as your downside stop. If it doesn't show a tendency to obey the 10-day moving average, then you're going to revert to the 50-day moving average as your guide for selling. So the basic idea here is to help prevent you from selling a stock prematurely if it is simply not its nature to hold a 10-day moving average. And some people like to use a 10-day moving average, but the first time the stock breaks down from it, they might just be bailing out or they might be using it too soon in the pattern so that they just end up getting shaken out of the position. So it has to follow the 10-day for at least 7 weeks before you're using it, and this prevents you from selling the stock prematurely. So our studies indicate that a stock within an uptrend and which is also shown to obey the 10-day moving average for at least 7 weeks following a buy point. And a buy point can be a standard issue base breakout, a pocket pivot, a Bible gap. So a stock that obeys a 10-day moving average for at least 7 weeks following a buy point should be sold upon its first violation of the 10-day line. And the violation is defined as a close below the 10-day moving average followed by a move on the next day below the intraday low of the first day. And we'll cover this in more detail in a little bit as we go through some trading simulation type examples. But let's look at moving average violations. And Dr. K, you want to discuss some of the concepts here that you can see in this stock, where it's violating and where it is not?
Sure, absolutely. Well, if you look at the pink 10-day line, you'll see that if you go 6 days into the chart, it closes below that pink day, the pink moving average, and then the next day it closes below the low of that low. So that's violated the 10-day. And if you go forward to the next time it violates the 10-day, and that looks to be in late September, you'll see that on that first day it closes right at the 10-day. So the next day is not a violation because it closed at the 10-day. So the next day it closes below the 10-day, and then so the third day, that's your sell day when it breaks below the low of that close. Everyone follow that? And then as you can see,
this day right here, where
yes,
where you're selling. Okay.
Exactly. And then it does the same thing with the 50-day you can see that it closes below the 50-day line, and then that second day it has a mini gap down below the low of that low, so you would just sell it out.
Okay, and then you can
If
see
you
here.
if you had been holding it that long.
Okay, and this is what you're talking about here on this break here, and that's a 50-day.
Yes.
So if in this stock you were using the 10-day moving average as your selling guide, then your out points would probably be either here or here, and if you were using the 50-day, then this would be your selling guide. Now, interestingly, this is Apple, and this is the break off the peak back around in the 650 area or so back last year in October, which started the downtrend that has now sent the stock down towards the, well, getting close to pushing towards 400, about 451 this morning, so down in an up tape as well, which is kind of interesting. We look at another example. Now, Dr. K, you might discuss this stock. It's a stock that here's your Bible gap up here, and does it follow the 10-day moving average for the first 7 weeks? Can you explain that whether this is the case or not?
Yeah, you can see that when it closes below the low of the 10-day, the first time it doesn't break below the low of that low, and then the second time, same thing. Second time would be in mid-September, closes below the low, closes below the 10-day, and then it meanders back and forth and does not violate. Now, if someone might ask, well, what about if you go? It looks to me like the late September, when it closes below the low. It could be that one, or it could be or it could be the one before that, where it closes below the 10-day. After that one, the mid one, the one in the middle.
But it never actually violates the 10-day because once you close on each of the times that you close, you never close below each of those levels. Right.
On the other hand, on that one that's right in early October, where it closes below the 10-day, if it were to go below the low of that close, that could be your sell point. In other words, it doesn't have to go below the low of that first 10-day close. As the chart forms out in the ensuing days, you could use that second 10-day or third 10-day close as your sell point. So that's where your mouse is right there. If it were to, right there. If it were to go below the low of that day, that would be a 10-day violation.
I see. Even though this line, after it went back above, it closes below the 10-day, but you're actually relying on this close here. But either one of these would take you out, right? So you could rely on this.
Correct. No, I'm just saying if you didn't know what was going to happen ahead of that, close below the 10-day, that would be your selling guide. But then it never goes below the low of that. Instead, it goes to new highs, and then rolls back over again, and then closes below the 10-day. And then the day after that, it does violate by going below the low. So that would be your sell point.
So what we would call this, in this case, the stock actually tends to obey the 10-day moving average, even though you can see the price is moving on either side. And so what's happening here is the stock does hold the 10-day moving average, and there are no violations based on how we define a violation. So remember, just because you have a close below the moving average does not mean that that's a violation. It must move below the intraday low of that day, as you have here, for that to be a sell signal. Now, of course, you could say that, oh, well, I got shaken out here and the stock moved up, but really it got you out after a little move here and after a base failure here, because this is a breakout here that fails. And so it gets you out, and once it starts to break down here, that's pretty much it, and you're out long before this thing gaps down. And if, let's say, you were using the 50-day in this example, even this, here's a close below, this would have gotten you out here before, and then again, here's a close below, and you move below and close below the intraday low of this day, and so this would have gotten you out. So either one of these would have gotten you out at the 50-day just before the whole thing tanked to the downside and blew apart. And that's essentially how moving average violations work, and in our new book we go into some detail on this as well. So hopefully people have this wired down by looking at the book and this webinar. So, but anyways, let's look at some examples here. Dr. K, you want to discuss Intuitive Surgical from 2009?
Sure. So you have your your Bible gap up there, and then it quickly violates the 10-day. In other words, it violates the 10-day within 7 weeks. So then you switch to using the 50-day as your selling guide. And as you can see here, it violates the 10-day again, but you don't sell. In fact, it doesn't violate the 50-day. If you go up to the top there, or near the top, you'll see it closes at the 50-day, and doesn't even close below the 50 days. So you're in clear. You're in the clear for holding onto this stock the whole way through.
Yeah, and the reason you're using the 50-day moving average for this particular stock is that right after the Bible gap up, which is right here, the stock immediately violates within, let's say, within 3 weeks, it violates the 10-day moving average. So it is not its nature to follow the 10-day moving average. It is the nature, you'll have to forgive my news service coming up, but it's the nature of the stock not to follow the 10-day here, and it shows that right away. So immediately you know, since this is less than 7 weeks, you know that you're going to use the 50-day moving average as your selling guide. Now here's Lululemon, and I think this does the same thing, does it not? You close below the 10-day moving average here, and then move up, back up through it, but still it's already violated it once, and so it's showing you that it doesn't follow, and the second time it definitely violates the 10-day moving average. You got to close below here, and then it moves below the low of that day, and so you're using now the 50-day moving average because it has, within 7 weeks, it has already violated the 10-day moving average. So that's going to pretty much put the kibosh on using the 10-day moving average, and now you're using the 50-day because it is not its character or nature to hold the 10-day. You're using the 50-day, and it holds pretty well up here and moves higher. This is Apple last year, and it's interesting that some people argue that the stock is a buy where it's trading right now at about 450 because it's round trip this whole move, and so supposedly it's supposed to go back up now, or you'll get an instant replay. But in any case, I doubt that's going to happen. But you can see that after this Bible gap up, Apple actually had a very nice uptrend last year, or actually, last year in the first part of the year, the first quarter roughly, and it followed the 10-day moving average the whole way. You had a close here, more or less at, slightly below, I think it was a few cents below the 10-day moving average, but it never moved below the low of that day, and it wasn't until you violated here that you were out of the stock. So you can see here you could be out of the stock relatively quickly off the peak, and this whole system is designed to help you lock in profits, because one of the biggest problems that we understand investors have from all the questions that we've received is the fact that they a lot of times will buy a stock and they'll see it run up, and they don't lock in their profits, or they don't really have a coherent system for locking in their profits, and they end up getting waiting too long and getting blown out of the stock at extreme lows on a pullback, and they really don't capitalize on the position as well as they can. This system is designed to keep you on track in terms of understanding whether to use a 10-day or the 50-day moving average as your selling guide, and when to use it for the purpose of doing exactly that, bagging those profits when you have them. And when you do have a very strong streaking to the upside type stock like this, and I'm sure several of you have probably had a situation like this over the years, what you see, what I see happen, and it's happened to me as well, is that you got this thing that's running up like crazy, and you think, wow, this is great, and it's moving like there's no tomorrow, and it's just jetting to the upside. But you really hate to see something like this acting so strongly, and you wonder, where do you start to take your profits? And what will happen is when it gets very steep to the upside, the pullbacks can be very sharp, and you're sitting there wondering why you didn't take profits at a certain price. This gives you a very convenient, very easy system to reference in terms of taking your profits, and in this case you would have taken them at a pretty nice price after this big move. Now Apple set up again and went higher, and at that point I think we were using the 50-day moving average, which we showed you earlier violated the 50-day moving average in October. Anyways, this is lumber liquidators. Here you can see a Bible gap up move, and you can see right away the stock seems to be holding. Now, Dr. K, how would you handle this part right here in mid-June? I believe that's June. Is that June? Or no, I'm sorry, mid-August, mid to late August there.
Yeah, okay, so it closes below the 10-day, you can see there, but what happens there, I usually use a dime, just in other words, you want to give it a little bit of flexibility, because sometimes it'll drift below the low by a few pennies. That doesn't mean it's violated. In other words, you want to, I usually use 10 cents as kind of my guide. If it's a higher price stock, you maybe use 20 cents or 30 cents. But in this case,
Okay.
you know, in context with the chart, I mean, you can see this, you know, visually, and that it hasn't really, there's no violation there, even though I think when I looked at this, it went below the low by a few pennies. So anyway, your stop's not hit because you would have given yourself at least a 10-cent cushion, and then it goes higher. And then finally, it actually violates it at the top there. But then that is your, it violates the 10-day after 7 weeks, so you're going to sell it there because it's obeyed the 10-day for 7 weeks.
Now, after you sell it, it gaps up, but this gap up move fails very quickly because for those of you who watched or attended last week's Bible Gap Up webinar, we talked about how you use the low of a gap up day as your selling guide, and then you can see this one broke down very quickly, so you would have been out on this move as well, and then the stock's built a whole new base, and it's starting to come back around. You can see here's a little pocket pivot right here, and a lot of times after you've sold out of a stock, the 7-week rule will get you out, and it'll get you out generally with a decent profit in the position. You can let the stock base and then come back, and we find that pocket pivots as well as Bible gap ups work very well in getting you back into a stock you may have sold on the basis of using the 7-week rule. But you never know what you've got in a stock until you sell it, really, and you never know exactly how high it's going to go. When something starts streaking to the upside and shows a 10-day moving average as the moving average that it tends to follow, then what that does is put you in a great position of being able to just unload the stock once it violates the 10-day, and that's usually pretty close to the peak. So very useful there. Here's Nation Star Mortgage. You can actually see here this stock came out of this, I think it was an IPO base back here. You had a big move here. I think there's a pocket pivot in here somewhere. I think this one for sure was a pocket pivot, but you can see right away the stock closed below here, but it showed within 7 weeks it violated the 10-day moving average. So you were using the 50-day moving average on this one, and you can see this would have kept you in the stock until here, until you finally broke down and violated the 50-day moving average. Then the stock sets up in here, and you get some Bible gap ups. And I believe the stock is probably up today, but I don't really see any new buy points there. But you can see how on this move here, here's your buy point, and very quickly within, I'm going to say about 6 weeks, not quite 7 it looks like to me, you violate the 10-day moving average, and you're using the 50-day as your guide. Here's Aquin Financial. This stock had a big move. Now here's a big pocket pivot on huge volume, and the stock just continues higher, and it definitely by this point, we roughly say 2 months here from this line to this line. It's about 8 weeks. It's falling, and so you're now using the 10-day moving average as your selling guide, and this gets you out essentially right here on this day here, and it breaks down, sets up a whole new base, and then you have a pocket pivot coming in right here, and you're back in the stock there. But you would have sold out right here on the basis of using the 10-day moving average, the magenta line, as your selling guide for the stock. I should point out on these charts you have the magenta line as a 10-day, the blue line is a 50, and the 200 is the red line here. Priceline had a nice move last year coming out of a base in February of 2012, and it ran up very sharply. And this is what I'm talking about. It's when you have a stock that just goes ballistic on the upside, and you're getting a great move out of the stock, and you're wondering, when do I lock this in? This is getting very steep, but it follows the 10-day moving average for about almost exactly 7 weeks, a little more, and then you start to violate here, and you're out of the stock right here at this point around the 720 level. So you've locked in a decent profit if you bought it down here around the 550 level. And then you can see later on it does violate the 50-day as well, but by that time you're out of the stock. So sometimes you will sell and you'll see the stock move back to the upside, but you don't let that bother you. You just stick to your sell rules, because a lot of times what will happen is you'll get a little reflex rally and then it will blow apart. Anyways, let's go through some questions. I'm just showing the covers of our 2 books. The latest one, In the Trading Cockpit with the O'Neill Disciples. That's the red cover, and the yellow covered one, Trade Like an O'Neill Disciple. If you have more questions after we, beyond what we're going to answer right now, and you're interested in finding out more about the material in the books, we have a huge FAQ section. You just type in a question, and it will take you to an answer or a series of answers on selfishinvesting.com. But somebody asked a good question, and I'm just going to back up here. Is asking that sometimes in our book we talked about, our first book, we talked about using the 20-day moving average, and there are some exceptions. I'll use the 20-day moving average, or sometimes the 22-day exponential moving average in certain instances. But that last year in 2011, well, actually 2 years ago in 2011, we used the 20-day moving average as a guide for the SLV, which showed a character to follow. And that was an unusual exception, but for the most part, we don't abide by the 20-day, or we don't use it. But there are some cases where you will see that occur, and so we will revert to the 20-day. But that's very, very rare, and the only time we've ever used that is with the SLV. So just want to point that out. Sessions 1 and 2, covering pocket pivots and then viable gap ups, yes, both of those are available on our website under, where would that be, Dr. K?
Sorry, come again?
Where would the prior videos of the session 1 and session 2 be located on the website?
Yeah, good. Let me see here. I think if you go to webinars, you're going to be able to pull up, yes, go to webinars section. So that would be virtuousoptioninvesting.com/webinars.
Okay. Or you can just go to the homepage, selfishinvesting.com, and look for webinars. Let's see, another question. Somebody says, that's giving up a lot of points. I mean, in hindsight, yes, and I don't know about you, but I'm not a very good hindsight investor. And when you see the stock moving up, how do you know when to sell? And you're never going to sell at the peak. And I think you're naive to think that you're going to sell off the peak. But if you're thinking in terms of points, you're thinking wrong-headedly about stocks and their movements. You have to think in terms of percentages. And if you can sell within 10% off the peak, in most cases, you're going to do very well. So if you look at this, if this violation here gets you out at 720 and the high was 774, well, percentage-wise, that's about 8%. That's not close to 10% or more than 10%. And even though you can say in hindsight, whoa, that's giving up a lot of points. Well, if you can find me a method that's going to get you at the exact peak so that you don't give up any, quote, points, and that's what you're concerned about, then please let me know, because I definitely love to use that one. But barring the fact that exists anywhere, this is the best you're going to do, in terms of being able to bail out of a stock that runs up very rapidly and shows a tendency to follow the 10-day moving average, and it gives you a very easy selling guide without putting yourself in the position of getting shaken out of the move on the way up. So, in fact, it's quite efficient if you think about what real-world investing is versus hindsight investing, which is what you're basically saying when you go, oh, that's a lot of points off the peak. Well, try and do better. And
yeah, the problem is, I think investors who get caught up in trying to buy at the low or sell at the top, that's the most expensive way to spend your time, because invariably, in every single case, I don't know one exception to this case, people who maintain that kind of focus, they lose their focus of the big picture. They tend to trade, in other words, in a more short-term orientation because they think the stock is top, so they sell too early and they miss the big move. Or in hindsight, again, because they see this kind of formation, this becomes more of something that they focus on. They're always looking for that top, and meanwhile, what they should be doing is let the stock run and run their screens on on a regular basis, so that they can catch the next big move. I mean, that's really the big thing, is you don't want to leave behind any potentially large movers, because when the best stocks start to move, often they don't give you much window of opportunity. So if your focus is not there, you may miss out on the initial move of some of these stellar names that have come and gone over the years.
Here's a question for you, Dr. K. Have you studied the percentage of times a stock has violated the 10-day moving average or 50-day moving average only to rebound a few days later and give you a potentially higher price to exit the position? In other words, how many of them will do what this one is doing, where you have a sell signal here and then it heads back up? Is there some percentage of these that will do it? And if there is there any way to determine whether the stock that you just sold is going to be one of those? It's
not a meaningful percentage, because you can't really group it. In other words, a lot of that movement has to do with general market action, and since you can't really predict general market action very well, it's kind of a meaningless percentage. In other words, you could take a market slice, say in 1999, in the last quarter when the market was going straight up, and you're going to get a very high percentage that actually where it comes down and then you want to hold on to it because it's going to go straight back up. And then you could also take a look at a year like 2008 before the crash, when the year was just kind of in a bearish mode, and you're going to see more failures. So I wouldn't get caught up in trying to capsulize the market in that manner. I mean, you're basically trying to oversimplify something that can't be oversimplified.
Yeah, and again, if you think about that question, what percentage of stocks will violate the 10-day or 50-day moving average and then turn around and go higher? Let's say you're handling Priceline in real time and you own the stock and it violates the 10-day moving average. Well, let's say if we gave you an answer like, well, 10% of stocks might do that. How do you know Priceline is one of those 10% of the stocks that will rebound higher? You don't. So as Dr. K said, it's kind of a meaningless question. So, and it may happen from time to time, but your objective when managing money or running positions in the market, stock positions in the market, is to capture as much of the move as you can. And I can tell you from my own experience that I think maybe only once in my life have I sold a stock at the peak of its move. And the other times you're selling down 5, 10, 15% sometimes, depending on how fast they break. But I think this is a very efficient method to use that's objective and keeps you away from having to guess whether your stock is going to roll over.
Trying to pick up a few extra points, when this thing's come off and then it goes back up. Those are crumbs. You want to focus on the meat of the move.
Right.
And that should be your general principle in all of your trading. And of course, there are going to be many times, where you're going to sell lower and the stock's going to go, it's going to bounce. But those are crumbs. And if that's where your focus is, that's what you're going to get in your trading, crumbs. I wanted to make one point on this chart actually. If you look at the peak day, it does an outside reversal on quite substantial volume, and so the 7-week rule I want to emphasize is it's a great rule. It statistically works quite well, but that doesn't mean you have to obey it all the time. There are going to be times where you want to sell ahead of the 7-week rule. And this is one of those cases where you could say, okay, it's got an outside reversal on big volume, and so if it goes below the low of that outside reversal day, I'm out, or I sell half my position, because that's a pretty bearish-looking type of formation, especially after the stock has gone straight up. Now, another type of bearish formation is if the stock has a gap down on you during the run, you might want to sell half or all your position right at the open, because if it's gapping down, who cares what the news is, as long as it's not a secondary. That's a different category altogether. But if it's negative news on the stock and it's gapping down, you might find that it goes a lot lower from its opening price. So I have a rule where in many cases, in most cases, I'm going to sell at least half my position if it does a gap down on me the next day.
Yeah, and a good example of a stock that did that recently would be 3D Systems, for example. Just gapped down and broke down through its 10-day, I believe. Let's go to some other questions. Someone's asking what subsequent price volume actions would negate or correct a 10-day violation, letting one get back in. Well, what I would point out here is if you see, for example, here's where Aquin OCN follows the 10-day, so it violates the 10-day moving average and you're out of the stock. So once you're out of the stock, all you're doing is sitting around waiting for a new buy point to emerge. And so here you have a buy point coming in as a pocket pivot up through the 50-day moving average, and that would be when you would re-enter. So the only thing that could get you back into the stock would be a new buy point, which could be a pocket pivot, it could be a viable gap up, or it could just be a standard base breakout, or some combination of the three. Someone says, is the violation on an intraday move below the low of the first closed day below, or does it have to close below the first closed day? So, Dr. K, in other words, if you close here, and if this was to shake out and go below this close and then turn back up and close above that low, rather than here you see it closes down, but let's say on this day it had closed up after violating this low, how would you handle something like that?
It's an intraday selling technique, so you don't wait for the close.
You don't. So once you see it happen intraday, you're out. So
Right.
I mean, if you
Don't put
depending on
yourself
where,
stop in there.
if you bought this stock say way back here, I think, and you have a huge cushion, you might wait to see where it closes. But if you had bought it more recently and you don't have as much cushion, then you definitely probably want to be playing defense rather than sitting back waiting to get hammered some more. So it really, I think, if you have a huge cushion in the stock, it might give you the luxury of waiting for the close. But if it's relatively close to where you entered the stock, then you probably don't want to be doing that. Does a 7-week rule apply to ETFs like SLV, Dr. K?
ETFs that are focused ETFs like SLV and GLD trade more like stocks. So yes, the 7-week rule can be used for that specific type of ETF. In general, it does not apply to ETFs because most ETFs are very broad-banded. In other words, they represent indices which are comprised of many stocks, whereas SLV and GLD are really focused on one primary commodity.
Someone asked a question. I'm not quite sure what this means. You use a 50-day moving average as a potential stop when you are sizing the number of shares you're buying. I would think sizing the number of shares you're buying isn't really related to the 50-day, but maybe what this person means is, are you using the 50-day moving average as your stop right off the bat? In some cases, that might be the case with the stock, because when you start out initially with a position, you don't know whether its nature is to hold the 10-day, so you don't know for 7 weeks whether you're going to be using the 10-day moving average. So right away, once you buy a stock, so let's say you bought this here, you might be using the 50-day moving average right away as your selling guide. How would you answer that, Dr. K?
Yeah, I mean, when you first initiate a position, using the 10 and the 50-day is not necessarily something you want to do. It's very contextual to what the market's doing. So if you initiate your position and then it goes back into the base, I often just sell. Especially if the market's strong and it goes back into the base, that means you're sitting on a name that's not keeping up. And if the market's weak and it goes back into the base, I may be a little more forgiving as long as I'm convinced that the market is just in a minor temporary bout of weakness and is going to recover. So you have to take it contextually in terms of how you handle your initial position in the first few days.
Right. So someone here is asking a question that reinforces what we're saying. So if within the first 7 weeks, something happened here. So if within the first 7 weeks the 10-day line is violated, we then look at the 50-day line and hold until this is violated. That's right. So if this had violated, but let's just use this example. You had violated the 10-day moving average in here and in here. So it does it within the first 7 weeks of a buy point, say right here, then you are using the 50-day. So it's basically a binary sort of choice. You determine whether it's the stock's nature to hold the 10-day after 7 weeks, if it does it for 7 weeks. And if it doesn't, and it breaks down below the 10-day very quickly, say within 2 or 3 weeks, then you are reverting to using the 50-day moving average. That's the essential concept. Charts are marked up in the book, so really we intend this as sort of an informational webinar to give you the gist of what we're talking about, but we go into more detail on this in the book, and that's really where we don't want to replace the book. Obviously, I don't think our publisher would really like that. So we're not getting. Is it possible to look at GDD as a recent mover? Let's see if I can do something here. So I can move a chart over here. So let's look at triple D. And you can see it held its 10-day moving average all the way up from these buy points down here. So by this point, it was 7 weeks, and you violated on this day here, which is 4 trading days ago. And so you would have been out about right here. But you can see when this thing starts to break down in huge volume, and it slashes through the 10-day, and you're using the 10-day moving average as your selling guide, sometimes we'll just blow out on that basis, right away, and generally that is helpful. So it's not, this isn't your textbook case. This is a pretty severe breakdown. So we think the stock at best needs more time to set up again, and that's going to take some time. I don't think you're going to see a rebound coming right back in. Okay, Dr. K, here's a good question. Do you base, somebody says, what do you do with 3D now? I don't know. Call your broker. We're not here to provide free stock advice or stock advice when something has already violated our to the 10-day moving average, as Triple D has. So all I know is we don't own it, so I'm not buying it. And if you still own it, then you can. If you're into praying, I suppose that might work. When do you start counting for the 7-week rule? When is it? Does it start with the buy point, or when the stock begins to trade above the 10-day moving average? So, for example, Dr. K, you can see here you have a buy point here and buy point here, but it does start following the 10-day moving average here,
right
ahead of the buy point. Do you count that?
It's contextual to the overall chart, and so in many cases you start on the buy day, but in this case you're going to actually work back a little bit, and when it comes basically through the 50-day, but again, I do have to see more of the chart to be able to tell you. If I think I would start counting on that first day where it clears the midpoint. Mm-hmm. So that would be looks like late May, not there, but the down below. Yeah, right there.
Right there. Okay.
That would be the start of my count. But that assumes also the chart prior. You know, if that really is a clear of the midpoint, then that would be my first starting.
Right. I got you. See, we're going to have to run through a few more questions. Do you use a 20-day anymore? I might. It depends on what it is we're looking at. If the SLV shows that it follows a 20-day, then we might use that. So, but the stock's got to show you what its character is, and you base everything on that. You don't. You don't try and anticipate what it's going to do in advance. So in other words, I wouldn't use a 20-day necessarily for something unless it showed me that that's its nature to do it. Somebody's asking also, why didn't the 10-day violation start point reset after the gap up in Aquin? It doesn't. I mean, you don't reset once you have a buy point and the stock shows that its nature to follow it 7 weeks. You don't restart, and you have another buy point, say, within the uptrend. So let's say here you had a buy point here, and you're starting to count from here, and then you have another buy point here. It doesn't negate all of this work if it was above the 10-day. You don't restart the count. It starts from the first buy point. So new buy points do not restart the count. Somebody asked, any particular reason why you use a bar chart versus a candle? We actually talk about that in the book, so we'll leave that for the book. And that's really all we have time for. We've already gone over 40 minutes, and we still have to deal with the market today. It's kind of a big day with the indexes up pretty big, and so we're pretty busy trading today, and we can't go on longer than 40 minutes, unfortunately. But hopefully this gives you some idea of what the 7-week rule is all about, and you can find out a lot more in both of our books as well as the website. I think that would be your primary three primary resources there in terms of learning more. But we did want to give you an idea of how the system works, and that it is intended to help you lock in gains when you have stocks that are moving very quickly to the upside. I know that's a big problem for people, as well as understanding when to sell your stocks and get out of trouble or lock in profits. And we find that that's the biggest difficulty for most investors when they have a winning stock. It's usually not a problem finding a stock that is moving to the upside or is a winning stock. It's really more of a challenge in how you handle it. And I know Bill O'Neill used to tell us that it's not what stock you buy, it's how you handle the stock once you've bought it, and that's what the 7-week rule is designed to help you with. Anyways, thanks for attending today's webinar. We got to get back to work. This will be available on our website as a recorded video, so if you want to review it, feel free to do so, and we will send out the link later on to everyone who has attended today. So we'd like to thank you for attending, and we'll talk to you guys next time. Take care.
So long, everyone.